Welcome. Today, we're diving into the essentials of creating a balance sheet. Whether you're a business owner, student, or just curious about finance, understanding how to build a balance sheet is a valuable skill. This video will walk you through each step, breaking down the process into manageable parts. By the end, you'll know exactly how to organize your assets, liabilities, and equity to get a clear picture of your financial position. Let's get started by exploring what a balance sheet is and why it's so important for any organization. Balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It lists everything the company owns, owes, and the owner's equity. Think of it as a summary of your business's health, showing what resources you have and how they're financed. This document is essential for making informed business decisions, attracting investors, and securing loans. Now, let's break down the main components you'll find on every balance sheet. The heart of every balance sheet is the accounting equation: assets equals liabilities plus equity. This equation must always balance, which is why the statement is called a balance sheet. Assets are what you own, liabilities are what you owe, and equity represents the owner's share in the business. Understanding this equation is crucial as it guides how you organize and interpret the information on your balance sheet. Let's look at each part in more detail, starting with assets. Assets are everything your business owns that has value. These can include cash, inventory, equipment, property, and accounts receivable. When creating your balance sheet, list your assets in order of liquidity, which means how quickly they can be converted into cash. Start with current assets like cash and accounts receivable, then move on to long-term assets such as property and equipment. This organization helps readers quickly assess your company's financial flexibility. Current assets are resources that can be converted into cash within 1 year. These typically include cash, marketable securities, accounts receivable, and inventory. Keeping track of current assets is vital because they reflect your business's ability to meet short-term obligations. When preparing your balance sheet, make sure to itemize each type of current asset for clarity. This level of detail helps you and others understand your company's immediate financial strength. Long-term assets, also known as non-current assets, are resources that your business expects to use for more than 1 year. These include property, plant, equipment, and intangible assets like patents or trademarks. Unlike current assets, these are not easily converted into cash. Listing your long-term assets separately on the balance sheet provides a clearer picture of your company's long-term investments and stability. Liabilities are obligations your business owes to others. These can range from loans and mortgages to accounts payable and accrued expenses. Just like assets, liabilities are divided into current and long-term categories. Current liabilities are due within a year, while long-term liabilities extend beyond that. Clearly separating these on your balance sheet helps you and stakeholders assess your company's financial obligations and risk. Current liabilities are debts or obligations that must be paid within 1 year. These typically include accounts payable, short-term loans, and accrued expenses like wages or taxes. Listing these separately on your balance sheet helps you monitor upcoming payments and manage cash flow effectively. It also gives investors and lenders insight into your short-term financial commitments. Long-term liabilities are obligations that extend beyond 1 year. Common examples include mortgages, bonds payable, and long-term loans. These are important for understanding your company's future payment commitments. By listing long-term liabilities separately, your balance sheet provides a transparent view of your business's ongoing financial responsibilities. Owner's equity represents the owner's claim on the assets of the business after all liabilities have been paid. It's calculated as total assets minus total liabilities. Equity can include invested capital, retained earnings, and additional paid-in capital. This section of the balance sheet shows the net worth of the business from the owner's perspective. Equity is made up of several components. The most common are contributed capital, which is the money invested by owners, and retained earnings, which are profits kept in the business rather than distributed. Some companies may also have additional paid-in capital or treasury stock. Listing these components separately on your balance sheet provides a detailed view of how equity is structured. Balance sheets are crucial for understanding your business's financial health. They help you track growth, manage debt, and make informed decisions. Investors and lenders use balance sheets to assess risk and determine whether to provide funding. Regularly updating your balance sheet keeps you aware of your company's strengths and weaknesses, allowing you to plan for the future with confidence. Before you can create a balance sheet, you need accurate financial data. Gather information on all your assets, liabilities, and equity. This may involve reviewing bank statements, invoices, loan documents, and previous financial reports. Having organized and up-to-date records makes the process much smoother and ensures your balance sheet is reliable. Balance sheet reflects your company's financial position at a specific point in time. Choose a reporting date, such as the end of a month, quarter, or year. This date will be the reference for all the figures you include. Consistency in reporting dates helps you compare balance sheets over time and track your business's progress. Balance sheets are typically organized into two main sections: assets on one side and liabilities plus equity on the other. You can use a vertical or horizontal layout depending on your preference. The key is to ensure that total assets always equal the sum of liabilities and equity. Setting up a clear format makes your balance sheet easy to read and understand. Start your balance sheet by listing all current assets such as cash, accounts receivable, and inventory. Next, add long-term assets like property and equipment. For each asset, include the amount as of the reporting date. This detailed listing gives a comprehensive view of what your business owns and its ability to generate future income. After listing all assets, add up the values to calculate your total assets. This figure represents the total resources available to your business. Double-check your numbers to ensure accuracy, as this total will be used to balance against your liabilities and equity. Accurate totals are essential for a reliable balance sheet. Next, list all your current liabilities such as accounts payable and short-term loans. Then, add your long-term liabilities like mortgages or bonds. For each liability, include the amount owed as of the reporting date. This breakdown helps you and others understand your business's financial obligations and risk exposure. Add up all your liabilities to get the total amount owed by your business. This total is crucial for understanding your company's debt level and for balancing the accounting equation. Make sure your calculations are accurate, as errors here can affect the entire balance sheet. Now list all components of owner's equity such as contributed capital and retained earnings. For each, include the amount as of the reporting date. This section shows the owner's stake in the business after all debts are paid. A clear equity breakdown helps you track how much value has been built up over time. Add up all equity components to determine total owner's equity. This figure, combined with total liabilities, should equal your total assets. If the numbers don't match, double-check your entries for errors. Accurate equity totals are key to a balanced and trustworthy balance sheet. The final step is to make sure your balance sheet balances. Total assets must equal the sum of total liabilities and total equity. If they don't, review your figures to find and correct any mistakes. A balance sheet confirms that your records are accurate and your accounting equation holds true. There are two common formats for balance sheets: the account format and the report format. The account format lists assets on the left and liabilities plus equity on the right. The report format lists assets at the top, followed by liabilities and equity below. Choose the format that best suits your needs and makes your financial information easy to understand. Let's look at a simple example of a balance sheet layout. At the top, you'll have the company name, the title, balance sheet, and the reporting date. Below, list assets, then liabilities, and finally equity. Each section should be clearly labeled and subtotaled with a final check to ensure assets equal liabilities plus equity. Many people use spreadsheet software like Excel or Google Sheets to create balance sheets. Spreadsheets make it easy to organize data, perform calculations, and update figures as needed. Templates are available online, or you can build your own format. Using digital tools streamlines the process and reduces the risk of errors. After completing your balance sheet, take time to review each entry. Double-check your math, ensure all assets, liabilities, and equity are included, and confirm that totals match. Careful review helps catch mistakes and ensures your balance sheet is accurate and reliable. Some common mistakes when creating balance sheets include omitting assets or liabilities, misclassifying items, and calculation errors. To avoid these, keep thorough records, use clear categories, and regularly reconcile your accounts. Being diligent helps you produce a trustworthy balance sheet every time. Once your balance sheet is complete, use it to analyze your business's financial health. Look at liquidity ratios, debt levels, and equity growth. These insights help you make better decisions, plan for the future, and communicate your company's position to stakeholders. Comparing balance sheets from different periods helps you spot trends and measure progress. Look for changes in assets, liabilities, and equity to see how your business is evolving. This comparison is valuable for strategic planning and identifying areas for improvement. Lenders often require a current balance sheet when you apply for a loan. They use it to assess your company's ability to repay debt and manage risk. A well-prepared balance sheet can improve your chances of securing financing and negotiating favorable terms. Investors review balance sheets to evaluate a company's financial stability and growth potential. They look for strong assets, manageable liabilities, and healthy equity. Providing clear and accurate balance sheets builds investor confidence and can attract new funding. Business owners and managers use balance sheets for internal planning and decision-making. By reviewing assets, liabilities, and equity, you can set goals, allocate resources, and identify areas for improvement. Regular balance sheet analysis keeps your business on track. Balance sheets are also useful during tax season. They help you organize financial data, track deductible expenses, and prepare accurate tax returns. Keeping your balance sheet up to date makes tax preparation less stressful and reduces the risk of errors. It's important to update your balance sheet regularly, such as monthly or quarterly. Frequent updates help you monitor changes, catch issues early, and make timely decisions. Staying current with your financial statements supports better business management. Balance sheets can be tailored for different types of businesses, such as sole proprietorships, partnerships, or corporations. The basic structure remains the same, but the details may vary. Understanding your business type ensures your balance sheet meets legal and reporting requirements. While balance sheets are valuable, they have limitations. They only show a snapshot in time and may not reflect current market values. Some assets and liabilities might be omitted or estimated. Being aware of these limitations helps you interpret balance sheets more effectively. The balance sheet is just one of several key financial statements. Others include the income statement and cash flow statement. Each provides different insights, and together they give a complete picture of your business's financial health. Understanding how they work together is essential for effective financial management. Many accounting software programs can automatically generate balance sheets from your financial data. Automation saves time, reduces errors, and ensures consistency. If you manage a growing business, consider investing in software to streamline your financial reporting. Good record keeping is the foundation of accurate balance sheets. Store all financial documents, receipts, and statements in an organized system, digital or physical. The key is easy access and regular updates. Organized records make balance sheet preparation faster and more reliable. If you're unsure about creating a balance sheet, consider consulting an accountant or financial advisor. Professionals can help you set up your statements, ensure compliance, and provide valuable insights. Their expertise can save you time and help you avoid costly mistakes. Follow best practices when preparing your balance sheet. Use consistent categories, update regularly, and review for accuracy. Clear formatting and detailed notes make your statements easier to understand. Adopting these habits leads to more effective financial management. Each time you prepare a balance sheet, take the opportunity to learn more about your business. Look for patterns, strengths, and areas needing attention. Over time, you'll become more confident in your financial skills and better equipped to guide your business forward. A well-maintained balance sheet supports business growth. It helps you secure funding, attract investors, and make strategic decisions. By keeping your balance sheet up to date, you lay the groundwork for sustainable success and expansion. Let's quickly recap what we've covered. We explored the purpose and structure of balance sheets, detailed each component, and walked through the creation process step by step. We also discussed common uses, best practices, and tips for accuracy. With this knowledge, you're ready to create and interpret balance sheets with confidence. Now that you understand how to create a balance sheet, put your knowledge into practice. Gather your financial data, choose a reporting date, and start building your own statement. Remember, regular updates and careful review are key to maintaining accurate financial records. Good luck on your financial journey.